You don't need a fortune to get started. In fact, $3,000 to $4,000 is more than enough to build a solid foundation in the S&P 500. It's a realistic amount for most American investors. Moreover, this sum already offers instant diversification without exorbitant fees. ETFs make this possible easily and quickly. Historically, the S&P 500 generates 7 to 12% average annual return. Pay attention, you must understand that this figure is observed over the long term, never in the short term. For example, some years disappoint, others exceed expectations. But statistically, this performance remains remarkably stable for over 100 years. It's this consistency that reassures serious investors. That's the true power of the S&P 500. With a single investment, you automatically own Microsoft, Google, and Amazon simultaneously. These companies dominate the global digital economy, so you gain access to the greatest innovations without manually selecting each stock. In other words, you benefit from 500 American champions in a single, simple, and efficient transaction. If you have time ahead of you, that is to say at least 5 or 10 years, then allocating between $2,200 and $3,300 to the NASDAQ 100 becomes interesting. In fact, this time horizon allows you to absorb fluctuations without panicking. Young investors have precisely this advantage. Time works in their favor. You'll find the largest technology companies in this stock basket. Nvidia, Tesla, Meta, and Apple dominated widely, and they represent a significant portion of the index. For example, these 4 monsters alone concentrate a major portion of your investment. That's where the power of the NASDAQ 100 lies. The profit potential far exceeds that of traditional indices. So some years, you'll see your investments rise by 30, 40, or even 50%. Be careful though, volatility is very real. You must accept that a 20% correction can happen at any time. That's the price to pay for these superior returns. Let's start with concrete numbers. To get started with dividends, you need to set aside between $2,200 and $4,400 minimum. This is the initial investment necessary to build a diversified portfolio. In fact, this amount allows you to buy several quality stocks. Coca-Cola, Pepsi, or other giants pay their shareholders regularly. The more you invest initially, the more your future income will be. That's what makes dividends extraordinary. You receive the money automatically. These payments arrive monthly or quarterly, depending on the company. You don't have to do anything. It's completely passive. PepsiCo pays its dividends 4 times a year, for example. Each quarter, the money deposits directly into your account. It's a source of income you can really predict and plan for. Now, here's why dividends reassure investors. Moreover, companies like Coca-Cola outperform tech stocks during crises. They sell essential products that people always buy. Even when the stock market crashes, these dividends keep flowing. Tech stocks, on the other hand, can lose 50% in value. Dividends therefore offer a stability that few investments can match. Here's the secret that the best investors guard carefully. Keep 5 to 10% of your portfolio in cash. In fact, this reserve is not a waste of money. It's insurance. When markets collapse and fear reigns everywhere, you stay calm. You possess the ammunition needed to act while others panic. Wait, there's even better. Some modern brokers currently offer 4.9% interest on your cash. For example, you deposit $1,000 in cash and earn $55 per year without doing anything. That is, your money works while it waits. You sacrifice nothing by staying ready to seize opportunities. That's where the real game is played. Stock market crashes rarely last long. When everything tumbles down, prices become stunning. Those who kept their powder dry buy massively at a discount. 3 months later, markets bounce back. You've then turned your patient waiting into extraordinary gains. Liquidity becomes your secret weapon. Let's start with the balanced approach, the one that works for most investors. You buy 4,000 shares of SPY for large American companies. Add 3,000 shares of QQQ for technology and innovation, complete with 2,000 shares of SCHD for stable dividends. It's simple, diversified, and accessible to everyone. But be careful. These figures are just examples. In fact, your age changes absolutely everything. A 25-year-old can accept more risk than a 70-year-old retiree. Your income also matters a lot. Your debts, your employment situation, all of this influences your choices. So adapt these proportions to your real personal situation. By the way, the common mistake is seeking the perfect allocation. You will never find it. What really matters is consistency and discipline. Choose a strategy that suits you and stick with it for years. The investors who win are not the smartest. They are simply those who stay invested without panicking.